Hello and welcome everyone to Tax Planning Through the Four Phases of Retirement. I am Deanne Rosso, President and CEO of Vickery Financial Services, and we are glad you've joined us today to talk taxes. And what better season to talk taxes than tax season? So I hope you enjoyed the tax facts and the music we had scrolling just now ahead, a few minutes ahead of our webinar today. Some interesting facts about the start of taxes in the United States or just how complex they are. So we hope to dive in a little bit today and talk about some of the complexities that you may face as a retiree when it comes to preparing and managing your taxes. Let me go ahead and share my screen with you all. The slides that we have today. So how tax planning changes through 4 stages of retirement. This is our topic for today in a series of webinars that we have launched at Vickery Financial. We tend to do those on a Tuesday once a month, and you can find the full lineup of our webinars on our website, vickeryfinancial.com. You can find a list of those upcoming webinars so you can tune in for those upcoming educational opportunities. So let's just kind of dive right in. Breaking news. I thought I'd start the day with some breaking news. The IRS has extended the 2020 individual income tax filing deadline to May 17th of 2021. So I thought I'd just kick the webinar off with that piece of information that just happened last week. And so that you guys would be aware that you've got some extra time to file your personal income taxes this year, although I know a lot of people don't want to wait, and there are certainly lots of benefits to getting it done early, especially if you're due a refund. However, I just wanted to let you guys know that just last week, the IRS decided to extend that tax filing deadline to May 17th, 2021. And as a little bit of bonus content today, if you stay tuned towards the end, I'm going to touch on just a few of the key components of the new American Rescue Plan, which is the new stimulus package that was just signed into law on March 11th, I believe. So sit tight and hang on for that. That will come towards the end of today's webinar. So why don't we start off today with a tax brain teaser. Bill is retired and he has taxable income of $42,475, a modest income as a single filer, which puts him in the 22% federal tax bracket. Of that $42,000, $38,000 came from his IRA, so that was IRA income. He also got $25,000 in Social Security benefits, and then he tapped his IRA for an extra $1,000 for a concert road trip, which sounds kind of crazy in this pandemic year to be taking a road trip. But Bill has been a very good citizen the last year, and he has quarantined and he is socially distanced, and now he's vaccinated. So he's ready to hit the road and take a trip. And he wants to take $1,000 from his IRA in order to take that road trip. So the question is, how much will he owe in taxes on that extra $1,000? Let's take a look at that. Well, if Bill is in the 22% federal tax bracket, that should mean that he pays 22 cents in federal income tax for every additional dollar that he takes within that threshold. Therefore, if he took $1,000, he should owe $220, right? Well, you know, folks, that this would not be a brain teaser if the obvious answer was the right one. So that is wrong. He actually owes $407 in tax, which is a 40.7% tax rate on that income. Now, why is that? How is that possible that he could be in a 22% federal tax bracket, yet owe 40% tax on just the extra $1,000 that he took out? And I think as we progress through our slides and our webinar today, you will see how his income triggered some additional taxes that ended up in him paying a lot higher rate than anticipated. So again, we're going to go through how tax planning changes through 4 stages of retirement. I'm Deanne Rosso with Vickery Financial, and along with me today, I have my sidekick, Betsy Harder, who is our marketing director with Vickery Financial, and she is going to tee up your questions for me at the end. So if you have questions as I'm walking through the slides today, please feel free to put those in the chat box. And Betsy is going to curate those questions for me and throw them to me at the end. And then I'll have a chance to walk through those questions, as many as we can get to during our time, about 45 minutes or an hour here today. So seek professional tax guidance. You might be saying, why is my financial advisor talking about taxes? Shouldn't my CPA be the one who's telling me about taxes? And the answer is yes, your CPA should be telling you about taxes. But at Vickery Financial, we believe that we should take a team approach when it comes to managing your retirement income. And a lot of that has to do with taxes. And so it's always best to consult a qualified tax professional to discuss your tax situation, especially when it comes to account types like your traditional IRAs, which are tax deferred, or Roth IRAs, where that money grows tax free and the earnings may be withdrawn tax free as long as you follow the rules, and with state taxes. Today, I'm going to be focusing on federal income taxes. But we all know in many states, as in Georgia, where a lot of us are located, there is a state income tax, although modest, and there are exclusions for retirees as well. So it's important also to pay attention to your state tax situation. But today, I'm going to be focusing on federal income taxes. So it's a new complex world when you enter retirement. And taxes in the accumulation phase or that saving phase are very different than in the distribution phase. Now, what do I mean when I say accumulation phase versus distribution phase? Well, um, as it's stated, the accumulation phase is simply that when you are working and earning and saving and socking away dollars into that nest egg to provide for your retirement income stream. But what happens when you retire and you decide to take all of that hard earned savings and turn that into retirement income? This is a concept that is very shrouded in mystery and can seem very complicated. So it's definitely a shift in thinking and how we have to think and how we have to plan for that spending phase or that distribution phase. A lot of times when we make that shift, we're facing a new tax landscape in that there are no more child tax credits for most retirees. Their children are now grown, at least in college, and are no more dependents and no more child tax credit. Mortgage interest deduction goes away for a lot of retirees that don't have a mortgage or at the very end of their mortgage and there's very little interest. A lot of times that employer paid medical insurance goes away, so we lose that benefit. We're no longer contributing to our 401k. So there are just lots of things that change for us when we flip the switch from working and into retirement. And then we add things like we add Social Security to that mix at some point, and we add required minimum distributions when we turn age 72. And then we have to pay for Medicare, most of us, or for long-term care. So there are lots of things that go away and there are lots of things that are added, and having a plan for how to stage that is really important. And here's the problem. People often pay more in taxes in retirement than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. So I often refer to this as a domino effect because a lot of times when you take additional income from certain sources, you may trigger that chain reaction or that domino effect that you didn't intend and end up paying more in taxes than you anticipated simply because there were tax triggers you weren't aware of. So we must develop a solution. And because your tax exposure changes throughout those 4 stages of retirement, you need a strategy that both anticipates the additional taxes and the possible taxes and surcharges and plans for the types of new taxes that may be incurred due to Social Security, Medicare, and other types of income. So, how do we manage all of that? Well, today I'm going to give you 4 keys that we need to pay attention to as we're walking through the 4 stages of retirement. What are the 4 stages of retirement that I keep referring to? So let's take a look at that really quickly. We have 4 stages here that are delineated by ages and description. And by no means is this to put anyone in a box. These are very fluid and flexible, and they can be longer or shorter, and they change as we go through retirement. But just to break it down basically into how we refer to the 4 stages of retirement, we have pre-retirement. And those would be those accumulation years that I'm referring to, where you're age 50 to 60. We call those the work and save years. You're actively, like I said earlier, kind of socking money away to plan for a retirement income stream later on. And then we have early retirement, roughly ages 60 to 70, when you decide to flip that switch and move into retirement. And our description for that is called the go-go years, because what do you want to do when you retire? You want to go, you want to do, you want to see. And I know that's been a lot different in the last year, especially for those of you who have been early retirees in the last year and have been quarantined or isolated at home. But that's not typically the case, right? So the go-go years are the years when you just really want to go and do and enjoy all those things you've been planning for in retirement. And then we move into middle retirement. And we call those kind of the go slow years. You worked and you saved, and then you go in early retirement. And then by the time you reach middle retirement, you're pretty content to pursue hobbies or kind of just slow down and spend more time at home, or just spend more time with the grandkids or the family. Just things that you do that are not traveling quite as much, or maybe not doing quite as much, but just settled into that retirement. And then, of course, we have late retirement. And late retirement being, it can be 80, it can be 90 plus. And the description for that is no-go years. After we've done all the things that we want to do in retirement, a lot of times that end stage retirement is encompassed by perhaps some health issues or just really slowing down. And that can actually be one of the most expensive phases in our life as we incur medical expenses. So just very simply broken down, this is what I'm referring to when I say the 4 stages of retirement. And it makes a big difference because your spending changes throughout these different stages in retirement. And oftentimes we get hit by surprises in retirement. Some of the most common surprises, which are great that they're not really surprises and we can sort of plan for, are inflation. We know that inflation happens. We know that $1 today is going to be worth more than $1 tomorrow. So we need to plan for our money to grow and our income stream to be able to provide for changes in inflation. Longevity. People are living longer. And so we need to make sure that our retirement income stream is going to provide for us no matter how long we live. Expenses, there are always unexpected expenses now in your lives and in retirement. Sometimes we need a new roof on the house. Sometimes we need an AC. Sometimes we have an unexpected medical expense. So always just plan for the unexpected. And then, of course, healthcare. Healthcare expenses are on the rise. They have been for a very long time. So making sure that your retirement income stream can supplement whatever health insurance, typically Medicare, but whatever health insurance that you have. Okay, so what's the first thing I need to understand about retirement and taxes? So key number 1 is you have to know what your after-tax retirement savings picture looks like before you retire. And what do I mean by that? Well, let's say that during those working years, pre-retirement, you saved $500,000 in your 401k or your IRA. And actually, you guys know this, it's not really $500,000 because you were able to save all of that money pre-tax, which means that every dollar you pull out of that IRA or 401k in retirement is fully taxable. So planning for how you take those dollars out is really important. If you're married filing jointly, your $500,000 could actually be worth $325,000 if you're in a 35% tax bracket, or $315,000 if you're in a 37% tax bracket. So your $500,000 is actually worth less because every dollar has a portion of it that's dedicated to taxes. And in addition, you're going to have to withdraw a required minimum distribution each year after you turn age 72. Now, the 72 lately, in the last couple of years, it's caught people off guard because a couple of years ago, they changed the law. The required minimum distribution age used to be 70 and a half. And starting, I believe, January 1st, 2020, that bumped to age 72. So you do get a couple more, a year and a half extra now of time before you have to start taking those required minimum distributions. And required minimum distributions, just like any other IRA withdrawal, are fully taxable. Okay, my IRA may be fully taxable, but at least I'll still have Social Security to supplement my income and Medicare to pay my health costs. And for most of us, that is true. But key number 2 is that Social Security and Medicare have their own tax traps, and you need to plan for those too. So what do I mean by tax traps? Let's talk about Social Security and taxes. Remember our friend Bill from our tax brain teaser? So we're coming back to his situation now. And remember, he took that extra $1,000 to go on that concert road trip. So before the trip, his IRA income, as you can see circled in red here, was $38,000. And after he took out the money for the trip, it was $39,000 because he took out $1,000 from his IRA. So the actual increase in income from scenario 1 to scenario 2 was $1,000. But Bill got hit by what we call the Social Security tax torpedo. So you can see here that his adjusted gross income, even though he only took out $1,000, went up by $1,850, and as did his taxable income, up from $42,000 to $44,000. And why is that? Well, that's because your Social Security is taxable based on all of your income put together. And so Bill happened to be right on the edge of a bracket that pushed extra dollars into some of his Social Security dollars into the bracket that made it taxable. So as you can see here in the yellow box, for every additional dollar of income that Bill received, an additional $1.85 was added to his AGI and his taxable income. So extra Social Security became 85% taxable, which caused an increase in income tax from scenario 1 to scenario 2 of $407. And that's why that $1,000 withdrawal incurred a tax of 40.7% instead of just a regular 22% that was his stated marginal tax rate. And it's because some of those Social Security dollars became taxable when that $1,000 pushed extra funds into that bracket. So you can see now how what I'm talking about when I say the domino effect. And every additional dollar, once you cross certain thresholds and certain brackets, can cause other dollars to become taxable. Medicare and taxes. We also need to pay attention to Medicare. And we need to watch out for what's called the IRMA cliff. And IRMA is, of course, another acronym. In our industry, we love acronyms. And IRMA stands for Income-Related Medicare Adjustment Amount. And it has to do with the premium that you pay for Medicare. So the premium that you pay for Medicare once you turn age 65 and you're eligible is based on your modified adjusted gross income, and it has its own bracket schedule too. So let's take a look at this example of George and Martha. George and Martha have Medicare Parts B and D. And if you'll remember, some of you may have tuned in a few months back for Chuck's Medicare webinar, but he talked in depth about the different parts of Medicare. But Part A is free. You pay for Parts B and D. So George and Martha have Parts B and D. In 2018, their modified adjusted gross income was $271,500. And then they sold some stock and they took a capital gain of $1,000. So capital gains are something that provide us with a tax advantage. They're often taxed at a lower tax rate than our ordinary income tax level. So taking capital gains in retirement can be a very important part of your retirement income plan when we decide how to withdraw funds. And for George and Martha, they sold this stock. They had a $1,000 gain. It's taxed at a 15% capital gains tax rate, which is lower than their ordinary income tax rate. So that's great. And you can see here from the example, they owe $188 tax. It's $150 for that 15% capital gains tax, plus $38. Now, what is the $38? Well, there's another tax called the net investment income tax. And over incomes of $250,000, there is an additional 3.8% tax on net investment income. And this capital gain fell into that net investment income bracket. So they owe $188 for their capital gains and net investment income tax. So that's an 18.8% rate, and that's what they owe, right? Well, again, trick questions today all over the place. So actually what happened to George and Martha is not any additional taxes per se, but the Medicare premiums that you pay are based, like I said a few moments ago, on your modified adjusted gross income. And it's, again, a bracketed system. So for George and Martha, when their income was $271,500, they fell into this third tier here, where their total monthly premium amount was $289.20 for each of them. But once they took that $1,000 capital gain and they crossed over that $272,000 mark, they moved up into that, or down, I should say, into that next fourth tier, which increased their total monthly premium amount up to $376 each. And it also affects their Part D, same concept. Once they cross that $272,000 threshold, they moved down into that fourth tier where their plan premium went to $50.70 each. So we know they had their $188 tax, but now they also get to pay extra Medicare premiums each month. And here's how that breaks down. Their monthly IRMA surcharge is what it's called. So George pays extra for Part B and D, Martha pays extra for Part B and D, and combined, the 12-month total for both of them is $2,544. So the stock sale plus IRMA total damage is the $188 for the capital gains and net investment income, plus the IRMA surcharges of $2,544, which is a total of $2,732, and that's a 273% real tax rate. So talk about the domino effect really being in effect there. That really hit George and Martha hard. The good news is that for IRMA, for those Medicare premiums, they only last for a year. What Medicare does is they look back to your income from 2 years ago to decide what your Medicare premiums are in the current year. So for example, for 2021 Medicare premiums, Medicare is using your adjust your modified adjusted gross income from 2019 to determine what your Medicare premiums are in the current year in 2021. And so George and Martha will have some opportunity in this calendar year in 2021 to make a plan to try and stay within a certain bracket so that their Medicare premiums don't escalate again in future years. Hopefully, if they keep under that $272,000 mark in this year going forward, next year they'll drop back down into those lower premium tiers. Wow. Are there other tax traps we will face in retirement? And I'd love to tell you no, but of course, you're here to learn about the tax traps in retirement. And so, yes, there are. What are some of those? So, key number 3 is you must plan how and when you will use taxable, tax deferred, and tax free assets to manage your income and tax brackets efficiently. What does that mean? Which accounts to spend first? So over time, during those accumulation years, you've saved in different sources probably. You probably have some IRA or some 401k. You may have been able to save in a Roth IRA. You may have some assets that are just in a bank account or in a joint investment account, like Sam and Mary here. So Sam and Mary each have $450,000 in an IRA, and they each have $60,000 in Roth IRAs. And then they have a joint bank account of $300,000. So we often talk about account types as being the wrapper that goes around an investment account that determines what tax treatment those accounts get. So in Sam and Mary's example, they want to spend $8,500 a month in retirement, and they need help deciding which accounts to spend first. So there's some conventional wisdom to this, which has been developed over time. And the conventional wisdom says spend your taxable money first, meaning your bank accounts, because those bank accounts are going to have little to no tax ramifications. Or possibly what we also can mean by taxable accounts are just individual or joint investment accounts, which get that taxable, that capital gains treatment that I mentioned a moment ago when we were talking about George and Martha. Then spend tax deferred money, your IRAs. The taxes on those funds have been deferred all this time while you've been working and saving. And then when you pull that money out in retirement, every dollar is fully taxable. And then last, spend your tax exempt money. And by that, I mean like Roth IRAs, which you don't get a tax benefit for putting money in a Roth IRA, but it's allowed to grow tax-free until you pull it out in retirement, and then it's also tax-free. So that can be a nice little bucket of money that you have available where you know there are no tax strings attached. So conventional wisdom, spend your taxable money first, then your IRA or your tax deferred money, and then your Roth IRA or your tax exempt money. But there's been a lot of studies done on this over time as to really what makes the maximum impact for a retiree in retirement. And we call this withdrawal sourcing. So taking some of sort of the studies and the science behind it into account, we have some alternative approaches. So perhaps instead of just spending your taxable money first, you do spend the taxable money first, but also you consider around that time converting some of your IRA money to Roth IRA money while you're in low tax years. So when you have the most tax flexibility, let's go ahead and try to get some of those dollars that have just been building up tax all this time into a vehicle that is not going to be taxed forevermore. And then we spend our tax deferred money until depletion. And then we spend our tax exempt money. And if we do it this way, perhaps our tax exempt money bucket at the end of the day is a lot more than it would have been had we not converted IRAs over time. So here's an example considering Roth IRA conversions. IRA or similar retirement funds are moved to a Roth IRA. But remember that every time you take funds out of an IRA, that dollar, every dollar is taxable. So that taxable amount is converted and it's added to your income stream. So in this example here, Jill converts $100,000 from her IRA to her Roth IRA. So Jill will have to add $100,000 to her income in that year. It will be fully taxable to her. And the conversion income will be taxed at her maximum, her ordinary income tax bracket rate, wherever that income happens to fall that year. And we use something we call filling up the bracket strategy. So here's just a simple bucket example of before the conversion. Maybe Jill's income had filled up her 10% bucket and it had filled up her 12% bucket, but she still had some room left in that 22% bucket. So in order to maximize the amount of dollars that she has in Roth later on, and also keep her taxes in check over time, after the conversion, she has filled up that 22% bucket without spilling over into the next 24% bucket. So this is completely, as the example shows, very fluid and something that in your early years in retirement, before you're taking your Social Security perhaps, or before you get to required minimum distributions, you have a lot of flexibility in deciding which bucket, which account your retirement income fund should come from. And we have a lot of flexibility to try and fill up the brackets while we're in probably what's going to be one of our lowest personal income tax situations of our lifetimes. Low income years are good for Roth conversions. So how many people last year had a lower than normal income year? A lot of working people did. And a lot of retirees may have as well, because last year the IRS waived required minimum distributions. So Roth IRA conversions in years with unusually low income allow us to completely fill up those lower buckets. So common examples of lower income years, like I mentioned earlier, a business owner with unusually low sales, or a business owner with unusually high expenses that offset a lot of that revenue. What if there's a year when you had a medical issue and you had high medical bills, non-recurring, that allow you to deduct those medical expenses? Well, that brings your income down. Maybe that's a good time to consider a Roth conversion. And then, like I mentioned a moment ago, after retirement, but before receiving Social Security benefits, pensions, or IRA distributions. I personally think that the early years of retirement, typically between the ages of 60 and 72, are the time for planning, because that's when you have the maximum flexibility in your tax structure, and we can really make a lot of these moves that would be beneficial for taxes for years to come. So let's shift for a moment and talk about charitable giving and tax planning. So obviously, for those of us that are philanthropic, we give out of the kindness of our hearts and because there are organizations that we feel compelled to support. But we can also do that and at the same time get a tax benefit for our gifts. Now, the Tax Cuts and Jobs Act, which is the current tax structure that we are under, did away with a lot of itemized deductions, and then it also increased the standard deduction. And for many retirees, it increased the standard deduction to a level where they're no longer able to get a tax deduction for that charitable gift. So then what are some of the ways that we can still continue to give charitably and get a tax benefit out of that? And this is one of those ways. So let's look at Albert and Shirley. They're in a 24% tax bracket, and they give $5,000 to charity. They've got $15,000 in existing itemized deductions, but the new standard deduction is $27,000 plus. So because of that, If you add their $15,000 in itemized deductions, and then you add a $5,000 gift to charity, that's only $20,000. So they don't even meet the standard deduction. So they're not going to get a true federal tax benefit for that charitable gift. What can we do about that? Well, we can do something called the qualified charitable distribution. And what this means is once you reach age 70 and a half, and with the Secure Act that raised the RMD required distribution age to 72, it did not raise the age on qualified charitable distributions. So that age is still 70 and a half. So starting that year, you can give up to $100,000 from an IRA per person, and it must go directly to the charity. But when you do that, it counts. It can count as your required minimum distribution when you get to age 72, but it's not reported as income. And because it doesn't raise your income, you don't get to deduct it either. But that distribution does not raise your income to a level where you need to take a deduction. So let's look at an example of how this works. Option number one, what's the cost of a non-QCD or just a regular cash charitable contribution? So for Shirley and Albert, the charity gets $5,000, and the $5,000 satisfies the required minimum distribution because they're over 72 and they took that money out of the IRA. So the money went out of the IRA, it went into their checking account. The charity got $5,000. Their RMD is satisfied, but that $5,000 is reported as taxable income to them because they received it in their checking account in cash. And then they get to pay tax on that at a 24% rate, which is $1,200 for them. So the total cost then of their charitable gift was $6,200 because they received the $5,000 in cash and then they had to pay $1,200 in tax on that distribution. So let's look at if we had done that with option 2 as a qualified charitable distribution. And instead of taking the cash out of their IRA, they sent the $5,000 from the IRA directly to charity. And this is something that your advisor can help facilitate. So the charity gets the $5,000. The $5,000 satisfied the required minimum distribution, and the $5,000 is excluded from taxable income. So the tax bill on that distribution is zero. So the total cost of the charitable contribution is $5,000 minus the $1,200 that it would have cost for the taxes there. And I'd argue that it's probably even lower than that because over time you've been saving that IRA. So the money you put in grew over time. So everyone wins in this situation, maybe except the IRS. But the charity gets $5,000. It satisfies the couple's RMD. It's excluded from their taxable income. And also, if we think about the example earlier of George and Martha, where capital gains triggered extra taxes, perhaps doing a strategy like this can keep your Medicare premiums in the right bracket as well. It kind of has that reverse domino effect, if you will. So for a lot of philanthropists out there, once you reach age 70 and a half, giving as a qualified charitable distribution can make a lot of sense. So I hope to have assets to pass on to my family in addition to just being charitably inclined. And how does this figure into retirement tax planning? So our last key today is key number 4, and that's organizing your assets for your family's benefit. Estate planning does still matter. So what do I mean by organizing your assets? I mentioned a few moments ago that different types of accounts get different tax treatment. And in this example, we're going to look at what we call a step up in basis strategy. And the definition of this is a rule that treats a beneficiary as if they purchased the inherited asset on the day it was left to them. So with estate planning, our goal is to make sure that beneficiaries are designated, that accounts are titled in a way that they will pass most efficiently to our heirs. And this is a strategy to do that. So Phil and Mary, for example, they have a joint brokerage account, and the acronym used here is JTWROS. So it's just a regular investment account titled Joint Tenants with Rights of Survivorship. And what that means is that when one spouse passes away, the other automatically owns the account entirely. So inside that joint investment account, Phil and Mary have $120,000 investment with a long-term capital gain. And you'll remember that long-term capital gains get favorable tax treatment. Um, but unfortunately for Phil and Mary, Phil is diagnosed with a terminal illness, and the physicians tell him that they expect maybe he's got about 18 months to live. And as unfortunate as that situation is, Phil wants to make sure that his family is taken care of, when he passes. And so he comes to the advisor, and Phil and Mary sit down, and they go through to make sure that their estate plan is in order. So let's look at a couple of scenarios that Phil and Mary have here in order to maximize their assets. So scenario one is really just doing nothing with that joint account. Phil does die. Mary inherits Phil's half of the joint account. So the step up in basis eliminates the long-term capital gain on Phil's half. So when I say step up in basis, the way the estate tax law works right now is when you inherit assets in a taxable account, you inherit those assets at the value of the date of death, and you pay no tax. And so in this situation, Mary inherits Phil's half at that step up in basis. But because it's a joint account and everything is 50-50, she only gets the step up in basis on his half, not on her own. So if she sold all the investments in the account, she'd owe only income tax on her gains, not on Phil's. So her gains equal long-term capital gains on her $60,000 plus any gains on the remainder after Phil's death. So the bottom line is, if she sold everything, Mary would owe tax on her $60,000 of gain. Well, let's look at scenario two. After sitting down with Phil and Mary prior to Phil's death, and we think about how we can efficiently title the portfolio in a way that would transfer assets to heirs with the least tax ramifications. We decide to move all the investments into one account in Phil's name. And unfortunately, Phil does die about 18 months later. Well, because we had made that move and now all the assets were in Phil's name, then Mary inherits the entire account from Phil, and the entire $100,000 and $20,000 steps up. So then Mary can sell and pay $0 in taxes because she inherited the entire account at the value on his date of death. So thinking about how accounts are titled, and when certain life situations happen involving your advisor, and making sure they're aware and doing a little tax planning at the time can really make a big difference when you're thinking about leaving a legacy and providing for your heirs long term. So just a question, when you go to sell your investments, would you rather owe tax on $60,000 of gain or no tax at all? And I think most of us would rather owe no tax at all. Long-term care is something else that is particularly in those that late stage retirement no-go years we really want to plan for on the front end. So just very briefly, not to go into much depth today on long-term care, but there are lots of different ways to fund long-term care. If you decide to go with insurance, your premiums may be deductible at federal and state level. The payments from those policies are tax-free to pay for reimbursement of those long-term care expenses. And choosing how to pay for long-term care can have a big impact on your heirs. So it's certainly something that needs to be discussed and built into your long-term plan when it comes to your retirement income and your legacy planning. So we have covered so much today in these 4 key points, and you may be a little overwhelmed at this point and thinking, goodness, how in the world will we ever manage all of this? And so, that's what advisors like us at Vickery Financial are here for. In fact, that is one of the areas where we really shine and can really help bring value to your long-term planning situation. Again, just to kind of recap the 4 keys and the different stages in retirement. In pre-retirement, very important to know your after-tax savings before you retire. Very important to try and fund Roth accounts as early as possible or consider conversions in early retirement. So, moving on to that early retirement phase, understanding Social Security and Medicare taxation, and filling those tax brackets in lower income years. In middle retirement, managing those planned R&Ds. So taking those early and middle retirement years to make sure that we're doing all of these strategies so that by the time we get to required minimum distributions, we have a plan for keeping taxes in check and your Medicare premiums lower. And then in late retirement, just making sure that over time you've thought through how to organize those assets and plan for long-term care and plan for leaving whatever legacy it is that you'd like to leave in the most tax efficient manner. So the solution to the problem is because your tax exposure changes over time, you need a plan that anticipates all of these things and how and when you tap your assets to cover those expenses. And understanding that domino effect, those ranges of taxes that you'll face at various stages in your retirement life cycle, and managing those actions so that you pay as low a tax rate as possible. We know we're going to pay taxes. What's certain? Death and taxes, right? So we know we're going to pay the taxes, but we can certainly work with each individual retiree situation to make sure we're aware of what's going to happen when we make changes, and we can keep that tax situation as low as possible. That distribution phase is complicated, and managing taxes happens throughout retirement, as I just mentioned. Mistakes can be costly, but they do happen. And so, it's like, our friend Bill who took that extra $1,000, or George and Martha who unintentionally, kicked themselves into that higher Medicare premium. But most of the time, we can take these mistakes and we can turn them into something that is a more favorable tax situation the next year, or just do a little bit better pre-planning to follow up. And education, planning, and advice is certainly needed to put all of these pieces together. So I teased you at the beginning of the webinar with the American Rescue Plan, and I wanted to just touch on 4 bullet points. There was a lot included in that act, $1.9 trillion of recovery relief. But I wanted to touch on a few of the key items that I thought would probably apply to some of you in our audience today. So the recovery rebate credit, which is the stimulus payment, that's probably the one that affects the most people. And the most important thing to understand about the stimulus payments is the income tier and when it phases out. So the stimulus payment, which is technically referred to as the recovery rebate credit, and the reason it's called a credit is because it is technically a credit on your tax return. Your income must be under $75,000 if you're a single filer, or $150,000 if you're married filing jointly. Everything phases out at $160,000 for a couple. So it's a very narrow window to be actually eligible for the recovery rebate credit. But it's $1,400 per person. And one thing that's different about this stimulus versus the prior stimulus payments were it includes all dependents, not just children. And so for more people who may be on the call today who may have had children in college, or kids who were 17 or older that did not get a stimulus payment for those children, you should get $1,400 for anyone who you claim as a dependent on your tax return. And there are a lot of retirees in particular who also claim their elderly parents as dependents. And you would get a stimulus payment for those dependents as well. So that's a big change from the stimulus payments that we have seen before. Another item of note is the 100% COBRA subsidy through September 1st of 2021. And basically what this means is, I know I've met with several people over the last few years who retired not by choice, involuntarily. And so if you retired involuntarily, or if your work was terminated involuntarily, and you are on COBRA or you were eligible for COBRA, the American Rescue Plan includes a subsidy of 100% of that cost of COBRA for the next 6 months. So that's something really important. And I've gotten some questions about, how do I get this subsidy? And employers should be, within the next 60 days, sending out notices to anyone who was eligible. And even if you chose not to be on COBRA, but you are eligible, you should receive a notice, and you should have a choice again to go on COBRA if you declined COBRA coverage before. And for some of you, higher child tax credits. The child tax credit has been at $2,000 traditionally. The American Rescue Plan increases that to $3,000 per child, or $3,600 per child if you're under age 6. So a higher child tax credit, and those are also going to be prepaid, just like the stimulus payments. So the stimulus payments and the higher child tax credits are actual tax credits that the government is prepaying you. So when you're thinking about stimulus, I've had a lot of questions over the last year of folks who didn't get a stimulus payment, but then all of a sudden got a higher refund on their, perhaps when they filed their 2020 tax return, if they filed already. And that's because the IRS sort of shores it up when you file your tax return. So there are checkpoints as to when they are checking your income to see if you're eligible for a stimulus payment. One of those for the American Rescue Plan is if you have not yet filed your 2020 tax return, it's your 2019 income. If you want your stimulus payment sooner and your 2020 income is going to be lower than 2019, might want to go ahead and quickly file that 2020 tax return, because that's what they're going to be looking at now to send you a stimulus payment if you're eligible. Again, that under $75,000 or under $150,000. And then the last checkpoint is September 1st, or 90 days following the tax extension deadline, which technically at this point is in August, since they just extended the deadline to May. But my advice is, if you believe that you'll be due a stimulus payment and your 2020 income is low enough, would fall into that range, don't wait to file. The sooner you file, the sooner you would be eligible for that stimulus payment. And even into 2021, so this time next year, when we're filing 2021 tax returns, if you didn't receive any stimulus, but your tax return for 2021, your income is under those ceilings, then you will be eligible on your return to get a credit, the recovery rebate credit. Okay, I've talked a lot of tax things today, and some of those may have really resonated with you, and some of those may have been completely overwhelming. So if you would like, we are always available to request a taxes and retirement planning overview meeting, where we will certainly look and include some of that, some of those provisions from the American Recovery Plan. So feel free to give our office a call and schedule a time to meet with an advisor and just sit down and see, let us help you, put you on track to make sure that you're managing your taxes through the 4 phases of retirement in the most effective and efficient manner for you. So at this time, I'm going to turn it over to my sidekick, Miss Betsy Harder, who's been monitoring the chat box this entire webinar, and we'll see if we have any questions that I can answer.
Okay, it looks like we have time for a couple questions. And if we don't get to yours today, we can go ahead and send you a response via email. But our first question is this might be a question for my CPA, but I thought I'd ask. I have two children who both work and pay taxes, but are young enough for me to claim as dependents. I don't receive a stimulus payment because my income's too high. How do I figure out what benefits us most as a family? For me to not claim them so they can file single and receive their stimulus, or keep them as dependents? You noted the higher child tax credits.
That's a great question. And that is a CPA question, but I'll give my insight into it, which is what defines an individual as a dependent for tax purposes is if you provide more than 50% of their support. So that would be an issue of working with your accountant to determine, do you provide, well, you probably know if you provide more than 50% of their support, if you're paying their rent, any of their bills, some of their groceries, those kinds of things. But if they're earning their own income, and their income is to a level where they're providing more than 50% of their own support, then they would file as single individuals and they would get their own stimulus. But again, CPA question, but in rough definition terms, if you are providing more than 50% of their support, then you should be able to file them as a dependent on your return. And then you would qualify for the stimulus payment. The child tax credit, though, is for children who are um, 16 and under. And the American Recovery Plan did extend that to age 17. So you wouldn't necessarily get a child tax credit. You wouldn't at all if they're over 17. But if you may get a recovery rebate credit if you claim them as a dependent on your return.
Very good. And if that doesn't answer your question, please let me know. Our second question is, did you say AGI for taxes to receive a check phases out at 160,000 joint account? Thank you.
I did I did say that. Yes. So the window, the phase out window for American Rescue Plan is very narrow. So it's from 150,000 adjusted gross income to 160,000 for joint filers. So the previous um, bills that legislation that allowed that called for stimulus payments, the windows I think were larger, wider, but this one is very narrow. So if you have any flexibility in your income, um, and you're in that 150 to 160 window, keeping it to 150 or less is in your favor, particularly if you have children, because you will get more money by keeping your income under 150,000 and getting all of the stimulus that's due to you versus just going up to just over 160 and missing out on all the extra dollars that's available to you. So it is in your favor if you have that type of flexibility to keep your income at 150 as a joint family or less.
All right. And our last question is, and then if we don't get to the rest, we will go ahead and email you an answer later. What's the phase out for the stimulus in the American Rescue Act? Does it work like the Irma cliff? Do you go over 150,000 by $1? Do you lose the whole thing?
Great question. The top level phase out for married filing jointly is 160,000. And yes, if you are at 160,000 and $1, there is none of that is available to you. So it is very important. Again, if you have flexibility to stay within the 150 to 160 range or lower, and that 150 to 160 is a phase out, so you're going to see a reduction in it as you get closer to 160. But yes, a dollar over 160, you've eliminated yourself from that window. So, um, if that's the case and you're really that close, we really should talk with your advisor or your accountant as to ways that you could bring that adjusted gross income down. Perhaps if you're still working and you're not maximizing, and you have a 401k available to you and you're not maximizing your 401k and you really are just so close, perhaps increase your contributions to your 401k, because basically it could be, it could be $10,000 of free money, or more. So it's if you are very close to that bracket, it would be really important to pay attention and to try and get down as close to 150 or below as possible.
Very good. We've had a couple more pop in, but we will go ahead and answer those via email later. And I just wanted to let you all know we're doing these webinars monthly on the third Tuesday or fourth Tuesday of the month at 10 a.m. and 6 p.m. And you can see our whole list of upcoming webinars on our website, and that's at victoryfinancial.com. You can click the resources tab, I'm sorry, the webinars tab, and you'll see our list of webinars there. If you'd like to reach out to Deanne directly, you can email her at deanne@victoryfinancial.com, or you can reach out directly to your own advisor. And then if you have any other questions about upcoming webinars or anything else I can assist you with, I'm Betsy, and my email is marketing@victoryfinancial.com.
Thank you, Betsy, and thank you to all of you who attended today. And yeah, I put our contact information up on the screen. But definitely check out the list of upcoming webinars, and we hope to see you at the next one.